Right, welcome back everybody, and welcome Ammon Acarapi. Ammon is a development finance expert with Loan Market, and he's an RFA, very experienced loan broker, somebody I've known for, must be 12, 15 years. I knew you back in the Rich Mastery days.
Yeah, it really was, yep.
You were knocking around back then, yeah.
Yep.
And I was the tax guy and you were the finance guy on their stages. So you're a past mobile manager. Which bank was that with? Oh, you can tell your story. I think you've got some slides on it.
Cheers, mate. Yeah, look, first of all, thank you very much for the opportunity. I have spent most of my career, if not all of it, helping Kiwis improve their finance through property or property development. Most days, most clients I meet come to me all excited. They've spent time with a builder or a planner, and they've worked out that they can build 5, 10 properties on their site. And then they quickly work out that it's going to cost between $1.5 to $5 million to develop. And they go, how the heck am I going to fund that? Most of them, however, have completely forgot to seek any sort of expert accounting advice around GST and tax. And that has a real impact how we fund their developments, and also, obviously, their tax position. So I think it's a really fantastic thing that the GRO have done with the development school. I'm really happy to be part of it. Just a little bit about my background. I studied at Waikato University, did a major in finance. Got my first job as an apprentice project manager. It was a family business. It was my introductory to property development. I was managing gated communities. Moved up to Auckland, working for a Auckland consultancy, teaching property investors how to build property investment portfolios and the importance of cash flow in those portfolios. It was there where I met a lady came and saw me with a contract for a property to purchase an Otara for $100,000. She also had a contract to build a minor dwelling for $100,000. Combined income was going to be $500 a week rent. Combined costs $200,000. Net yield 13%. That was the start of a business that I had called Fuso Minor Dwellings. We built 350 minor dwellings around Auckland, mostly for clients. However, as most builders work out, you make more money doing the developments for yourself. So I established my own property portfolio there, funnily enough, all home and incomes. GFC came around. You could go into the market, purchase a completed development for less than it was to buy land, build a minor dwelling. Fuso closed its doors. I was approached by ANZ to become a mobile mortgage manager, which is where I learnt residential mortgages and the fundamentals of lending. When I was at ANZ, we were there incentivized to put people into the one bank trap. Didn't sit well with me. I left the bank.
Just define the one bank trap, brief.
So the one bank trap is basically when you've got more than one security, often your own home and investment property with the same bank, and essentially the bank has their hooks on both properties. They have control over what you do with the funds. If you sell one property, you think you might be able to spend them, but they might want to reduce your debt with them. So if you're working with property investors and they've got 4 or 5 properties, and as an ANZ mobile mortgage manager, trying to get them all to the bank wasn't something that sat well with me. So I went and started a brokerage for a bit, but I had the property itch and reopened Fuso. This was pre-unitary plan. We did do minor dwellings again, but we also got into terraced house developments. At the time, it was called medium density housing, and we did 4 projects in South Auckland. We got consent for a big development in Macquarie Road called the Chelsea, and got consent for 70 terrace sites in West Auckland. Didn't go through with building them. The banks basically ran out of funds there's a big influx in these sorts of buildings, and the banks sort of really pulled back and funding those developments. So sold those developments, basically sold the land, and sort of had a recalibrate of what I was doing. And basically with the skills that I'd learnt and the unitary plan had come out, I could see that there was a market to go and help people with development finance and help them get funding and understand finance to get this funding. So I've been given me and my business partner the loan market development finance franchise. And what I've also been doing recently is got an ebook out and worked with Lotsco to build the development feasibility part of their platform. And currently I'm trading a couple of properties and pre-approved, ready to buy development sites in areas of New Zealand that Matthew has taught us all to look out for. So I'm looking forward to doing that.
Oh, I think you know how to make a quid, Ammon. I'm not teaching you much.
Mate, too kind. Now, this is a render of one of the developments we did in South Auckland. This is the renders of the development that we had sold the land on. Essentially, ANZ here said initially they'd give us 80% of the construction costs to build, and then a few months after we'd started pre-sales and we got to 50% pre-sales, they said, "I will only give you 70% on a $25 million project." An extra 10% is quite a bit. I had JV partners, but then they dropped that LVR down to 50% and then to 0%. They just dropped all appetite for this sort of development. So,
were you in construction or pre-construction?
No, this is pre-construction. So very lucky. So all the people who put their deposits got their money back, and we actually made money on the land increase going up. So it ended up not too bad, but
good looking product.
What's that, sorry?
Good looking product.
Yeah, no, it was great. Yeah, it was a bit of a shame it didn't happen. So this is the ebook. Now, this ebook's been offered to everybody here tonight, so just contact GRA to get your copy of that. A lot of the stuff that we talk about here tonight is covered in more detail in this. Now, so what is development finance? Essentially, development finance is the exact same product a developer would use to build a $150 million inner city apartment, hotel. It's the same product that a developer would use to subdivide up a paddock into multiple sections, just like Matthew's currently doing in Rolleston. But I spend a lot of my time explaining the difference with what development finance is to clients, difference between a home loan and a development loan. The complete chalk and cheese products. So the home loan obviously is generally 20 to 25 or 30 years. LVRs up to 90%, current interest rates, where they're increasing between 4 and 6% at the moment. You borrow so much money you borrow $1 million off the bank, you pay them back $2 million. They can offer you cash backs, they can pay the broker. Development loans completely different. They're generally 1 to 2 years. Interest rates are currently between 9 to 16%. And the application fees or establishment fees between 1 and 3%. They unfortunately don't pay us brokers. The broker fees are added into the loan. They have such things called line fees. These are fees that are charged monthly on the undrawn facility limit. We'll go into those a little bit further on in the presentation. The LVRs are typically between 50 and 70%, but they are steadily dropping at the moment. A year ago, you could get a 75% loan on these sorts of loans, but today, currently between 60 and 65% is generally where they're lending. If you're developing to sell, it's going to be on the GST exclusive value that they will give you your loan. So what are some of the key principles of development loan? The good news is, a lot of people say, is that there's no income assessment. The focus is purely on the performance of the project, i.e. how much profit you're making in the development and how much equity you're bringing into the deal. So if you're coming into a development loan with next to no mortgage, that's a very good starting position. And if you've got that 20% to 30% margin, that's an even better margin. So they're looking at the overall LVR. A key principle of a development loan is capitalised interest. So capitalised interest is the good news piece. If you're doing $150 million project, who wants to service on a monthly basis that type of loan? Nobody, right? So capitalised interest is essentially the loan, the interest being lent into the loan itself. So this has to come in under the maximum LVR. This de-risks the project from the lender's point of view. Essentially, you're borrowing the interest. You don't service the loan until you pay it back at payment. You pay it back at the end of the project. The lender is going to look at the developer's experience. If they don't have a lot of experience, then they're very focused on the development team. They're going to look at the developer's statement of position. If things are to go wrong in the development, they're looking at things, what else they can get their hooks into to protect their position. They're very focused on getting their money back. The two main ways of getting their money back is through either sales or refinancing to a first-tier lender. And of course, they're very interested in product and location, making sure that you're developing the right product for the right area. Two key principles I want to discuss and introduce you to. Gross realisable value. Essentially, this is the end value of your project. Let's say you're building 5 terraced houses, $1 million each. Obviously, the GRV is 5 million. If you can get 65% of that, that would equate to $3.25 million. The next principle is total development cost. This is the sum of the development costs, all the input costs, including land costs, consents, construction costs, sales costs, and importantly, financing costs. And then the all-important calculation, gross realisable value less total development costs equals your profit. Now I want to show you a simple but pretty impressive example to kick off development finance. This example is for a retired couple living simply on their superannuation. It's a mortgage-free property, 1970s Keith A style home. They'd lived in the property for around 30 years. And the unitary plan came through and upzoned the property. Section size is 3,500 square metres. The new zone was single housing zone, which is the lower of the zones, but they previously were in a rural zone. Essentially, so what they could do is subdivide it into 600 square metre sites. The developer came knocking on their door, made them an offer. What offer was made? The land could be developed into 3 sections. The biggest section they were to build their dream home on, sell 1 section to fund the house, and the developer get the profit from the 3rd section. This is what it looked like, the dream home on the bigger home. See, the site was contours down that way, so you couldn't actually use that bit of the land. The 2 other sections were 750 each. It's the floor plan and the renders, approximately 220 square metres, the house. Renders a little bit to be desired for, but I'm the lender, not the architect. Can't blame me for these. This is the high level feasibility. I hope you can see these numbers. Sorry if you can't. The realisation.
We can see them. That's good.
Oh, you can? Okay, yeah. Cool. So the realisation, the house and land that they were building was 1.9, the 2 sections 1.05 each, total realisation of 4.05, and allowing for sales commissions on the 2 sections. You'll see here that the lender actually allowed for us to allow for rent for the clients to rent another house while they were having their house constructed. So these lenders would allow this to happen, which is awesome. Just a key note here, this does not look very granular at all. Behind this, brokers, we get sent all the consents, all the reports, but it's our job to condense these into these feasibilities for the lenders to understand, but we do provide them all the documentation behind it. In here, you've got civil works for 338,000 from Lamison Consulting. I'll go a bit more into that shortly. You've got 220 square metres at 3,800 square metre, total construction there. We allowed a contingency. Now we get into the financing piece.
What year is this? What year is this development?
This is a good question, 2019. So the interest rate is around that 9% mark. We started talking 2019, it sort of got completed 2020.
And what are you building? Is this a 3 lot or a single or just a house being built?
So this is a subdividing into 3 and building a house.
Okay, so and so they're creating sections and they're building a house, new house.
Correct. Yep.
Okay. Yep.
So under Anthony's previous presentation around the GST, they didn't actually pay any GST. So I'm not too sure where they got that advice off, but I don't know if they fluked it or it's just how it happened. Yeah. So
the construction is in relation to a family home.
Yeah.
And so they would argue it's not continuous and regular, and that the scale of the subdivision at the back was low, whereas the scale of the development of the house is a separate thing.
Yeah. Oh, I get all these sort of scenarios come through to me, and I really
it's complex.
It's so complex.
Yeah,
so complex.
And you'd think that there's a generic principle, and there is, but the nuances of the case change the answer.
Yeah, they come to us financial advisors, right, asking for tax advice, and we really have to be so careful. We just have to deflect it all and send them off to people like yourselves. Yeah, it really puts us in a really precarious position. So we come to the finance costs here, and this is where I want to spend a little bit of time just talking about how we handle these finance costs. So 8.95% isn't 78,000 on that cost there. We've got a factoring figure here of 65%. Now that 65% is the
average draw.
It's what, sorry?
The average draw period.
Yeah, that's right. Yeah, so it's called the factoring figure. So it's what the financing industry use to allow for the fact that you aren't drawing the total loan amount on day one. You're paying progressively as your loan balance increases. So all lenders accept this figure of 65%. So essentially, work out your 12-month interest payment, times it by 65%, and you put it into your calculation. So that's a universal principle of development funding that all brokers and lenders will use. The lender fee being 2% on this deal, and broker fee 1%. So total finance costs of about 120,000. So TGC, total development cost of 1.46, led to a LVR of 36%. Sorry, I can't see myself. 36.7%. So now the client's had this decision. Do we get a developer to come and do this all for us, or do we do this ourselves? The lender, because they're working with a group house building company who was going to take care of all the consenting, all the construction, the code of compliance, and the titling, they met with the client. They got the application through with all the consents. They actually supported this. These clients were in their 70s and 80s and were living on the pension. They actually supported them in this venture. So the clients actually did it themselves without the developer. So that figure of 3,380 was actually the higher of the estimate figures that the consultant provided to me. And then I added contingency on that. I never got to the bottom of how much it actually cost the client, but I know that they spent the total amount plus the contingency plus some. I don't exactly know how much it is, but as we all know, through development, it always takes a little bit longer and it's going to cost a little bit more. But there was such a buffer, such a safety margin in there, that it didn't have a massive impact on them. This is the Roland Road outcome. They ended up selling the sections for more because we're in the upward lift in the market. They sold both the sections for 2.4. The total development costs are 1.46. They ended up working away with their dream house and cash in the bank of close to $1 million. A completely life-changing event because the unitary plan came in, upzoned their land, and they met the right people and got a good outcome. So that's what can happen with development finance and development. So who actually offers development finance? Now, Chris actually covered off a little bit of this. So those slides that I do actually come to where he covered off, I'll just sort of skip through those. Don't want to be a broken record here, but he did it very well, which is credit to Chris. I know he's a very good quality broker, and getting into this development space is a bit tricky. So the banks, very often clients will come to me and say, I want an interest rate of 4 to 5%. What can I get it from the bank? I've been banking with the bank forever. They know who I am. They like me, that sort of thing. Banks are always going to look at experience. If lacking, they'll want to use more professional management, get more involvement from the quantity surveyor. They're looking at the developer's equity, strength of the position. Pre-sale cover is a big thing with banks. They want to see at least full cover debt, and more now they're actually asking for more than the cover of the cost. They're wanting to allow for settlement risk. So they're wanting you to pre-sale the value of houses more than the cost because of pre-sales, because of settlement risk, people not being able to settle. About a year and a half ago to 2 years ago, they'd let you start funding the development once you'd hit sort of 80% debt cover. So there's been a big shift in that, and that's due to the the number of just settlement fallovers. They're looking at the one in good location, good design, which isn't a surprise. So of course we want to know who the first tier lenders are, but the first tier lenders are broken up into segmentations, right? So you've got retail and business banking, which is who most of us will deal with when we get in our mortgages or got our business banking relationships with the banks. The different segmentation is the commercial part of the bank, where not a lot of people actually play. Matthew does, and big time property developers, and they end up dealing with a part of the commercial part of the bank called the property finance unit, very commonly known as the PFU unit. And they deal with the big time property developers. 90% of the clients that I work with don't get to this part of the bank. 90% of the clients I work with will be playing in the retail business part of the bank.
I dodge the PFU. They're more expensive and they're difficult buggers to work with. So 90% of my lending is in, BNZ Partners and that level. But
Okay.
when you do a larger development like Darfield, you get pushed into the PFU, which is, it's annoying because you pay more. But you also deal with sophisticated bankers who are fantastic. So you pay more, but you get the money and you get more too. So
yeah, exactly. A lot of within the PFUs, they quite often employ quantity surveyors and the like. They actually headhunt people with that big.
Yeah, and you don't want your main lending to go into the PFU. That it's not an ego trip; it's a price increase. So you want your main lending to be in the retail and business banking side, and they'll control your costs. And then if you're doing developments, then you reluctantly get dragged across into the PFU.
Exactly right. Exactly right. Yeah. So I did a survey of the banks. So I had a hunch that this was going to be right because we sort of do this all day, every day. And I know Chris sort of touched on this, that ANZ and ASB are head and shoulders above all the retail banks with their lending appetite for infill housing. But there are catches. So ANZ will allow one lot into a 4-lot development to occur, but they need to ensure that the client can service the end debt as a long-term investment property. And when we're talking about $1.5 to $3 million worth of end debt, there's not many clients who sort of can take on an extra $3 million, considering test rates where they are at the moment. Even once you chuck in rents and all that sort of stuff into it, they are a unicorn client that actually can sort of fit this sort of lending at that 3 and 4 level. 1 into 2 lot, sure, get quite a few clients through there. But a key point is that they don't allow pre-sales, future potential pre-sales, or even actual pre-sales to mitigate shortfalls in servicing. That's like a open bridge loan, and banks are all about risk reduction. So clients will quite often come to me and say, "Oh, but I intend to sell 3 and only hold 2." It's not a strategy or a solution for first tier lending. ANZ have just recently increased their contingency allowance for cost overruns to 15%. So we go from ANZ to ASB. They do a maximum of 1 to 3. The same scenario as ANZ with servicing, pre-sales. They've got a 10% contingency. Now this is where it starts going downhill. Westpac have no maximum lots, but the conversation that I've had with the BDM that I've had over and over again is very limited appetite, not really their space. Kiwi Bank.
Can I give you some feedback?
Yeah, sure.
I'd like to give you some feedback because we've got 10,000 entities we act for at GRA.
Yeah.
There are most of our clients like property or want to buy lots of money and have lots of properties. So we see what goes on with the banks. During the GFC, the worst bank, absolutely the most disgusting bank to their customers was ANZ.
Really? Yeah, the
and
biggest bank.
So what we say is don't look at what they're offering you at the front end. It's think about what they're going to do at the back end when the cards start to fold a bit.
Yeah.
And what we found with ANZ was that they would once a customer went into default, they would just mortgagee sell them. There was no off switch. There was no bad bank or credit default person to go and talk to, sit down with and say, hey, I want to do a deal. And they just mortgagee sold and bankrupted clients. And the other banks all had credit default teams, and the bank managers that used to lend money become the guys that manage the mortgage book and try and get them through the difficult situation. So I don't know if ANZ still have that model, but they did a lot of harm to our clients. And as a result, we've cautioned our clients about them because they're such a big bank. The person and their culture is very much, they back office their applications to India. So you either get approved or you don't. And if you get approved, the person in the front office, who's your local bank manager, tends to get promoted or leaves very quickly because they have a high staff turnover. So you could find yourself in a changed environment with a new banker that has no relationship with you. And that's what you get with big Aussie banks. And we certainly saw a lot of our clients have a difficult time with ANZ. So our main relationship, which is with Chris Peterson Mortgages, for main bank lending, we've always cautioned them about that because we just had so many cases of it with them. And we just think that type of banking where you don't have a relationship and a company that cares with an off switch, that's bad for business. So that's what I want to say about ANZ. ASB, the Bank of Nana. They've got a CEO that came in, and it's like she read the triple CFA and took it personally. And I had a loan on a boat that rolled off, and it was a small loan. It was $200,000. And in the wider scheme of things for me, that is a cup of coffee, and the bank knows it. And I said the loan rolled off, and they wanted me to reapply, which so I had to go and get bank lending for all of my entities and rental statements for all my rental properties, and then financial statements for everything. And I just said no. And they said to me that all of their high net worth clients were telling them to get stuff because I just repaid the loan, and then another loan rolled off on another property, and they said, "Oh, we need you to reapply." I said, "No, get stuffed," and just paid it off. So I paid off 3 loans with them. I don't owe them a cent now.
Yeah.
And they're just, they give excellent customer service, and their IT is good, and they're an online bank, and the money's there instantly when it gets paid. But they're the Bank of Nana. I just will not deal with their lending teams because they're just so conservative at the moment. Westpac give the worst customer service in New Zealand. Won't deal with them.
Who do you work with?
Just terrible. Like that, when you're dealing with the lending teams. Okay, and I owe, I don't know, I've got at least, I think I fixed 28 million at 3%. So I'm a decent sized borrower. So I did that 18 months ago in the GFC. So I have really good experience with banking because I do a lot of banking myself. And that's all buy to hold investing, and it's in my various JVs, and our LVRs are quite low. So don't think I'm a maniacal crazy man. We just have a lot of assets. But Jesus, Westpac, when I tried to get any customer service on some debt I had with them, lucky I didn't have any here because it would have all fallen out. They were absolutely terrible to deal with, and I will never deal with them again. And that is systemic through the client base. They all tell us you can't get hold of anybody because they're just so thin on the ground in New Zealand. So
yeah.
there's my three, my system of those three banks. Now we get to these three, and Kiwi Bank, fantastic.
Really? Jeez, they are the worst bank for a broker to deal with, hands down.
Oh,
Post office.
They give me whatever I want, and they give me one-to-one customer service, and there's no nonsense, and their IT is really good. BNZ, amazing, absolutely amazing.
Yeah, BNZ are good. Yep.
Yeah, and I haven't had a good one with TSB, but a lot of my clients have.
I remember seeing you walk a TSB banker into your office when I was hanging out in your office for a while there, mate, and talking about some development funding.
Yep, and he has done good things for my clients, but they don't do well with larger borrowers. I don't fit on their forms.
Yeah, no, that's
right. With TSB, if you say, look, refer attached statement of position because it doesn't fit on their form, it goes in the too hard basket for them. So larger borrowers with larger portfolios forget TSB, but they're very good because we've watched our client base use them with good effect. Yeah. And these other two banks are excellent. So there's a bit of seasoned feedback from somebody that's in the game and has been in the game for coming up 25 plus years. Yeah. And we have a large client base, and that is feedback from the client base and from me.
Yeah, no, and you're quite unique because you do a lot of your own banking, right? So you would be approaching the various channels where you do get that one-to-one interaction with them, but more than, which is a pretty different channel to where us brokers come through. So it's very very valuable information to hear. Yeah. Yeah.
Well, I'll probably Kiwi Bank want to service me directly because they don't want to pay fees, and their model is that. But they do now have a broker channel, so
correct.
Either that or I'm a target customer for them as possible. That they certainly do give good service to me. Yeah.
No, very good.
I used to love ASB, by the way, but geez, under this current CEO, they are so conservative. They're just an annoyance to deal with.
Yeah. Well, thanks for feedback. So with regards to our development funding or sort of infill housing. There's not a lot of scope for this because of the debt servicing, basically. Debt servicing sort of knocks a lot of the clients that we work with sort of out of the park, so they need to look for other solutions. So when we go to the PFU unit, and these guys, so this is talking about developments over the 5 million plus, proper, sort of 10 million plus type of thing. Can be residential or commercial developments. They are looking for taking care of their existing client base. They want clients who they've lent money to, who have completed a development and repaid them. That's who they're saving their money for these days. They're not looking to establish new banking relationships. They're looking to continue to foster their current relationships.
That's exactly right. Yep.
Yeah. They're looking for experienced builders who are, acceptable to their QSs. They quite often will use the NZ S3910 fixed price contract, which is a very much more commercial contract. I was involved in one as the developer once with BNZ and had QSs involved. It was an absolute learning curve for me. I wouldn't call myself an expert in it, but I have been involved in it, and I can sort of navigate my way through it and understand questions to ask. They do sometimes allow the master builder contract on smaller deals, which is great. They rely on the QS to confirm budgets, which is really good. And they're really looking for that 20% magical mark profit margin. If you're not hitting that 20%, they're pretty much trained to go, does this developer, does he know what he's up to? It's a bit of a red light if there isn't a 20% margin in the development for them to sort of really pry to see what the developer's even looking at it for. As mentioned, pre-sales are up to 120%, all consents granted, and valuation bank panel, consultants approved, program approved, all by their QS. So heavy reliance on the QS, which, I mean, I must admit, having listened to this development school and having the QS from Whites and Consultants on, and Matthew's opinion of it has really sort of changed my opinion of QSs. I've found them to be a bit of an embuggerment, to be fair, but
the trick is to use Darren. The trick is to use Darren.
Well,
Like White Associates are just commercial. They're great. Yeah. But they are an annoyance. Like there's no question. You should, we just drew down our development funding for the 20th in the last week. Every month we get 63 pages off them, and you've got to go through each page and their assessments and the development, and you've got to prove every bit of it. 63 pages every month you've got to go through. It takes about 4 hours.
Wow. Yeah, absolutely. And you pay for that. But how my opinion's changed is that, what if you missed something? They're going to pick up stuff that, you're not, and you've sort of admitted this, Matthew, that you're not actually qualified to pick up. You could be if you wanted to be, but, you'd rather spend your time doing other things.
100%.
So, yeah. So, no, a real good takeout from this school.
And the other smart people on your team, whether you like it or not, are the banks.
Well, that's right. If they're not going to give you the money, the
banks come in and ask all the right questions.
I usually use the condom on the deal. I don't.
They ask all the right questions. So,
exactly. Exactly. Well, essentially, they're putting up the money for it. They're putting more money into it than you are. It's their money, so they're very, very particular about who and how they lend it. Yeah. So this is a slide that I discussed with Matthew beforehand. The security that the banks take when they're giving these big loans, they're always going to be after the first mortgage over the security property. If you're introducing any other collateral security, which I'll go into a little bit further, they're going to want a first mortgage over that. They're after GSAs over the borrowing entity. The guarantors need to provide all right security over the property, all in present future pre-sales, and any other related assets. Full recourse guarantees for directors and shareholders, sometimes limited to recourse that can be negotiated. So, Matthew, just saying that you'd gone through this with your Darfield project.
Yep, I mean this is a standard sort of a thing on any development, and so taking those points, they want the first mortgage, so they'll take out the other security, which can be annoying because it might be cheaper. So you might jump from a 6% lender to a 8 or 10% lender, but they want the first, so that's just part of the game. You've got to do that. We've talked about GSAs. They want the first GSA. You guys take the second GSA back to your related party lending. Of course, you're going to have to provide guarantees. Don't give your wife's guarantee or your husband's guarantee. Sacrifice one of you up the front. Don't put both of you in there. So don't make your spouse a co-director. You're just putting them in harm's way. So when they say they want full recourse guarantees, your guarantee is worth nothing, hopefully, because everything's in trust. You should do that before you start this game. But if you are going to provide a guarantee, you can limit it to a reasonable amount. So if you're borrowing 10 million, you might say that you're going to limit your guarantee to the 10 million plus 2 years interest costs. And that might sound like a lot of money, but if you've got 15, 16 million worth of asset that you're developing, how much can you possibly lose? And you don't want to have a guarantee for a sum far exceeding their initial structure. If you can limit it down to a smaller sum, you should. Tripartite agreement between the developer and the builder. What they want you to do is they want you to assign the right for the contract with the builder to the B&Z in the event of your default. So that can be an annoyance because the contractor essentially has to sign a piece of paper that says in the event you fail, they'll continue to do the work for the bank at that price. So there's nothing wrong with that. It can annoy your contractor, but most contractors are used to it and aware of it, so they don't mind it. Assignment of any pre-sales and future pre-sales, again, that's an annoyance. And we had 23 million of pre-sales on Darfield, and they wanted us to go to each pre-sale and get them to sign an acknowledgement that the pre-sale was being assigned to the bank. And I pushed back and said, no, that is just going to run my lawyers around the block and waste everybody's time. We're happy to give you a generic assignment that you can exercise in the event we become insolvent. And they accepted that. So the point is that all of these things on the screen here, all these conditions precedent that they want before they lend the money, you can negotiate them.
Negotiable, just like anything in property, right? Negotiable.
Yeah. So just get people around you that can help you negotiate. That's the moral of the story.
So
and I'm sure Ammon can do that with you, and so can people from GRA.
Yeah, with the help of GRA for sure. Yeah.
And yourself.
Okay. So pros and cons of borrowing from the bank. So one of the biggest advantages, you're going to get the lowest rates and lowest establishment fees, more flexible in the regions outside the main centres. Experienced developers can get good deals. You can negotiate their rates and establishment fees, and they can be more tolerant of significant delays. Now, the logic behind that is they've got deep pockets, so they're not as anxious to get their money back if it's been extended. It doesn't have as much impact on their balance sheet if they've got a project that's been delayed. Whereas a non-bank, if there's delays, that really affects their whole operation. That they sort of survive by rolling their lending over. Disadvantage: more pre-sales required to get projects started, which is the big one. Likely to lend lower proportion of LVRs, more conservative, which is why they charge a lower interest rate. More paperwork, which Matthew sort of explained through the QS. QS reports are always required for the bigger developments. QS monthly payments, more restrictive terms to owner builders.
My QS is $1,500 to $2,000 a month. So
negotiated.
Well, no, that's White & Associates. They're quite reasonable. Yeah. And I've seen other QSs charging like wounded bulls, but just saying, I suppose the scale and complexity of the deal. Our deal's pretty simple.
Yeah. Non-bank lenders. Yep. So sometimes called the specialist development lenders, construction lenders, second-tier lenders, private funders, private lenders. Not all non-bank lenders are the same. There are around 20 to 25 development lenders in the market. More and more, we're up until probably about 8 months ago, sort of entering the market. I generally like to use the tried and tested guys. Lenders there's a particular lender who I've used a lot of, who's been around for 28 years, and they've only had 5 mortgagee sales. What that says is they work with their clients when things go bad, or basically loans take longer to repay, developments protract. So they essentially what they're going to do is they're going to sit down and work with their clients to get a favourable outcome. So a good test of how they handle, a good test of who's not a good lender is how they handle when a loan needs to be extended. The terminology in the industry is called rolled over. You take a 12-month loan term out, you don't quite get title, you can't settle, you need another 6 months, whatever. How do they handle that? A good quality lender will give you the same interest rate they gave you at the start, and they'll pro-rata the establishment fee. So if you paid a 2% establishment fee at the start for a 12-month loan term and you want an extra 6 months, they'll charge you an extra 1% at the same interest rate. A poor quality lender will put you straight onto penalty interest, could be 20%, and they'll really turn the screws on the developer. They'll become
30%.
30%, there you go. And they'll turn the screws on, meaning they'll just be very uncooperative, won't even communicate, they'll just send letters. These guys can also be known as lend-to-own lenders.
I call them loan-to-own.
Loan-to-own, sorry, yeah, that's the one, loan-to-own lenders. So these guys, at the worst, they will see a feasibility and they'll go, this doesn't stack up, I'm going to lend to this client, and they will actually hope that you default, they put the screw on, and that they end up owning your land. And there are a number of these lenders out there. There are sharks out there, and they are, what's the term? Sharks and clothed as lambs, or
wolves in sheep's clothing.
Yeah, that's it.
And listen, this is so important. You listen to Ammon on this. You need to stay away from these guys, because they are loan to own. Yeah. They know it's going to take you 15 months. They lend it to you for 12. You get to month 12 and you're nearly finished. You've done all your construction. You're waiting for CCC or 224C, and they retrospectively applied default interest at 28%. I've seen one of these lenders do to one of our clients last year. We said, do not use that lender. He's loan to own. And they got up to settlement and they retrospectively charged 8 months interest at 28%. It was $2 million as a penalty. And they used Bell Gully, great lawyers. So it's lawful. And they took full proceeds, didn't pay the GST, didn't pay a bunch of the subbies. It's disgusting. They just steal the money.
It really is.
So choice of lender in the non-bank sector is very important. There's a lot of unethical people in this area.
Yeah, absolutely. Yeah.
And we're not going to name them because they're really rich. They'll sue us. So we'll just they'll just say, we know, who the sharks in town are, and I'm sure that Ammon will guide you.
Yeah, exactly. Thinks that.
Yeah.
Okay. So when you're buying from them, generally the non-banks, they'll go up to $20 million. 65% including excluding GST if you're developing to sell, 65% including GST if you're developing to hold. 1 to 2 year loan terms based on your loan size, the development program. We've discussed this exit strategy, selling by sales or refinancing. A key point here is on smaller deals, they don't always require pre-sales, which is big, because as we all know, it's quite easier often to sell a house when it's completed and the client can walk into it, see what it actually looks like, feels like. You can quite often get a higher value for that. And in an upward market, if you sell at the start of a project, then and the market's going up, it tells you it takes 12 months to finish, 18 months to finish, you miss out on that capital growth. So very popular with developers to use non-bank lenders for that fact alone, that you don't have to get those pre-sales. Not saying that you shouldn't get pre-sales to de-risk yourself. However, in an upward market, a very good aspect. In today's market, the lenders are getting obviously more concerned about what's happening in the market, and these lenders are sometimes asking for pre-sales when they wouldn't otherwise, particularly in areas where there's high concentration of terraced housing. So that they will ask for maybe a pre-sale or two to just demonstrate what the market appeal is. However, I mean, when you think about it, that you're getting a pre-sale today, you're still not going to be completed your development for 12 months, 6 months. These lenders are very smart, and they're constantly mitigating and assessing their risk tolerance. As we discussed, capitalised interest, the interest rates, and what their lender fees usually are. So non-bank lenders are willing to take more risk, but will charge more for the money. They do take into account many bank criteria, but generally focus on the ability for you to complete the development and what the LVR is on completion. They are more focused on the project rather than your experience, and if the project can realistically be delivered by the proposed builder and consultants. They want to know if it can be completed, if it can be sold easily, and would they be happy to own it? That becomes one of their very biggest criteria. If they end up with it, are they happy to take care of it, and can they finish it? A lot of these second tier funders have actually got, they're actually development, wealthy families and other people in New Zealand, and they are developers, and they've actually got a lending division to them. So they actually are developers and know what it means to develop. So pros and cons of borrowing from a non-bank. Often no pre-sales are required, not required. No pre-sales allow an earlier start. Can borrow higher LVR of the gross realisable value compared to banks. Less documentation required than banks. More likely to lend to owner builders and builder developers than banks. So quite often you'll get a builder or a subby come to us and say, hey, look, I've got mates, I can get cheap rates. Can I get a loan from the bank? The banks don't like that. They want a master builder contract, fixed price building contract. So this is a good solution for those guys. These lenders will come and meet the client one-on-one, and they are open to giving them a loan and letting them, take advantage of their networks and their buying power experience. Disadvantage, higher interest rates and fees, maximum loan 20 million. Many will only lend on projects in cities with limited regional lending, and that's becoming more and more evident. There are certain non-bank lenders who will now only lend in Auckland, I've had to cast my net out rather wide now because these lenders are actually running out of money. So I've been speaking to lenders in Christchurch who will only lend in the South Island. So they've become quite territorial and they really have their feet on the ground and understand their markets, which is a real pro to them. You can really develop a really good quality relationship with these non-bank lenders. They actually do want to meet the developer, and they are loyal to those developers who are loyal to them. It's a great thing. So borrowing from any lender, all lenders are constantly assessing risk versus reward. This causes changes in their appetite and therefore loan conditions, maximum loan sizes, LVRs, pre-sale requirements, QS input, valuations. These levers have been pulled frequently at the moment. Frequently, we're constantly, like on a weekly basis, asking who's got money, what LVR they're lending to, and not surprised to hear of any sort of movements at the moment. I've got a list of about 20 people I email on a Monday saying, have you got any money, basically? Please let us know. So my job is to go to activate the market for my clients. I'll go and get 2 to 3 offers, and I compare each offer by a matrix of various things, and each offer that's presented by a non-bank lender isn't uniform. It's not a uniform offer. There's hooks in them. Sometimes they'll advertise a low interest rate, but they'll have a line fee in there. And when you annualize that line fee, it actually works out higher than the interest rate from another lender. So there's a whole lot of educational or just understanding that you need to understand how to read these letters of offer. So I present a lenders table like that, and help you understand which offer is the best one for you. Now, development feasibilities. Now, the way I want to sort of explain this is by showing you a couple of examples. This example is in Point Chevalier. This is a live deal. This has just been funded just very recently. It's client's owner-occupied house, currently on 1 title. It's fully consented for four freestanding dwellings. Each dwelling's 3 levels, single garage, 3 to 4 bedrooms, 2 bathrooms. Please note in this example, there is a second mortgage involved. Again, I'm not an architect, I'm the broker. This is the plans I got sent. It's sure to show the 4 floor plans, a couple of elevations. So this client, he had another offer, but he was required to get 2 pre-sales. However, he wanted to he wanted to sell near to completion, but more importantly, he wanted to get started sooner. Once this development's completed, he's going to build a property and build a family home in Waipu, which he has consent to do so. He has a current master builder contract with Group House Building Company, and the building company also manages the subdivision and civil works. Just to show you this, I'm not expecting you to read this. This is how granular we can get. This is how granular this one was. I'm going to break it down for you. So this is the realisation, the 4 lots, the sizes, and the end value. So we're dealing with gross realisation of 7.7. Now he is selling all 4 of them. So let's go to, and he has spent some money on it. So let's go to the balance to complete column here. So we're taking out agents' fees, we're taking out the GST to get to a net realisation. That's what the figure we're going to be lending against. He's got an existing mortgage of 1.3 million on this. He's put this money into the project thus far. He's got the consents and paid for the design and all that sort of stuff. To come is the civil works and post-construction sign-off. Here's the construction costs of all 4 houses. Contingencies have been allowed in the contract. Here's the finance. We've been through how we calculate that, 65%. So total finance costs of 390,000. TDC, total development cost, 4.9 million. That gave us a LVR of 76%, non-bankable, non-fundable. So how are we going to deal with that? We actually require, so this lender, so just to point out here actually, so this is a live interest deal, 9.75% interest rate, 1.25%. Now this lender never has a lot of money. I think they could charge more. I hope they're not listening to this. But the reason why this lender is involved is we're in Point Chev, 4 standalone houses, off-street parking, off-street parking, and it's a good quality development. The client's got a good statement of position. They want to lend to this client, but they'll only go to 60%. So this client is short required equity to get to that 60%, 1.3. They've put in 300,000, so we're about $1 million short. So let's go to the next slide. So the client put in $100,000 cash injected into it, and they also made an adjustment to the cladding to bring that down by 200,000. These are the sort of levers that we look at sort of pulling and are available to us. But to bridge the gap, we actually got a second mortgage of 688,000. Now,
how much do they pay for that?
That's at 15%, and they actually have to service that themselves. So that's not capitalised into the loan.
Oh yeah.
So yeah. So
and what year is this?
This is today.
Oh yeah.
Yeah, this is today. Yeah, this funds haven't. A bit more of the backstory to this.
That sounds cheap for a second. That's cheap for a second. 15. What's the app fee, or what's the fees on that?
3.5%.
So 18.5. Okay.
Yep. And plus by 1%. So yeah. It's pretty pricey, but the client adds it all up, and they say it enables me to go forward. They could have shelved this whole development, not built their own house, and
well, it makes sense if 10-15% of the funding is at 20% and the rest of it at 10. Their average is 12. So
you bring in the rate
between making the money and not making the money. Yeah,
absolutely. I mean, mezzanine funding, which is something we haven't got into, but and to be fair, there's not a lot of second operators who will offer second mortgages. Now, actually, Matthew, you just started a business to offer second mortgages, is that right?
Yep. So Slesh and I have started GC Finance, Gilligan Finance. We're now fully registered with the FMA, and
that. Well done.
just did my second loan today. Yeah, so we're lending, and we're doing second mortgages, and we're doing firsts. So we're in business.
Would this be a sort of loan that you'd be interested in being involved in, something like this?
Yep, totally. Yep,
yeah,
100%. Yeah.
Yeah, brilliant. Yeah. So it's always great to have another lender on the panel, because just at the moment there really is a shortage of funds in this space. Like I say, I spend a lot of my time calling around looking for money. So what we're able to do here is, with the second mortgage, plus the money they'd already spent, plus the extra $300,000 injection, we got to that figure that we needed to, and we got the LVR down to 60%. Now, but more of a backstory is the lender is actually committed to the client to lend money once they get money back in. So they don't actually have the money today, but they've given a letter of offer and intention to say that they will give the money once they get paid back monies from other developments that they're lent on. That's the environment that we're in at the moment. A lot of these second tier funders are just out of cash. And they are, and the reason for that is the protractment of deals, getting monies back, COVID, job shortages,
supply chain disruption,
supply chain. And what a lot of them have had to do, where they get this money from the lenders, is they blend their own money with the banks, give them a line of credit, and the banks are actually saying, we want you to have more money in reserve, increase your reserves to service those loans that are taking longer to come back in. So some of them have actually stopped lending money while their reserves increase to get to that click over to be able to then start lending again. A couple of the biggest lenders who are very well known didn't lend all of May, not one new deal. But what they do to keep operating, because they make money by lending money, which is the great thing about all lenders, they all need to lend money to make money, is that they start forecasting and selecting deals that are attractive to them, that are coming up, that they can marry up with their own money. So so this is one of these deals. I wouldn't, you've got to be careful. These lenders are very well known, and I do trust them a lot to put this client to them and sort of carry a lot of weight with what they're saying. So, yeah. Third example, last example, Wharf Road in Te Aratu. This is consented for 8 terraced houses. It came to me with $1.25 million of existing residual debt on the land. The LVR was too high based on that debt and the residual value. We introduced some more collateral security. One of the collateral securities was a family member. The added equity achieved the right LVR, but let's dig further into it. 8 terraced houses. These are the prices. Now, 6 of the 8 have been pre-sold. One of them was a private sale. The client doesn't want to sell the other 2 until we get to later down the completion. So this looks, on paper, at first glance, this is looking good. However, let's look down this line. She's going to sell them all, so we've had to take GST out. So the net realisation is $6 million. The existing mortgage 1.2. Get down to total development costs. Now, this is just a very high level. I didn't collect any other documentation. What I'll quite often do with clients when they come to me, I'll get high level numbers and we'll run some high level FISOs. If it's looking good, then I'll start collecting more information, getting the clients to spend more money sometimes. But this is one where I didn't need to do that. Once we added in the financing fees, we ended up with a LVR very high at 78%. There's no way I could get funding for that. So we started a conversation and turned out that we had other securities that we could add into the mix. One being of which her owner a rental property, and one being a family member's property. So we call these collateral securities. So they're not the development security, but the other securities added into the lending mix that we can use as security to get that equity up. These other securities actually came with extra debt, so we had to put that into the mix as well. Comment here is that we don't have to take the GST out of the collateral securities because they're whole properties, so that the GST figure stayed the same. Everything else stayed the same except for the extra debt added into that.
You'd have to say that there's correlation between the LVR on the face of the deal on completion and gross development margin. And, you know, if you're having to chuck all that collateral security and the deal's higher risk anyway because it's got less margin.
Oh, absolutely. Absolutely. 100%. 100%. And this is mate, you should be a loan writer or an underwriter. Within 20 seconds, you said no deal. And this was, even though we got the LVR to 65%, which 6 months ago would have worked, the lenders have gone, this is messy, this is ugly. You know, another family member's property, LVR's where it's at. Also,
terraces out in Te Aratu are just overcooked.
Absolutely, absolutely, absolutely. So it was a whole lot of quick no's. It was a whole lot of quick conversations I had with a few lenders. And it was unanimous.
Some of the nastiest developments in the country have been done on the Te Aratu Peninsula.
Oh, okay. Yeah. No car parks. I'll tell you what, trying to get any lending for development that's got no on-site car parks, off-street car parking, is almost impossible.
Yeah.
The lenders are smart. It's their money. They're going, what is the end value of these? What
do I want to own it at the end? Yeah,
what's that, sorry?
They're thinking, do I want to own it at the end?
Exactly. Yeah. Just my business partner worked for Housing New Zealand as an acquisitions manager, and so he sort of got a really good insight into how they think. And you know, they're looking at what happens in those little developments and the sort of people that end up in there, and just the socioeconomic situations that occur. You know, there's just violence and just horrendous outcomes. Pretty scary. Yeah. So anyway, this was an example of, now in happier, rosier times, this sort of strategy to make a development fundable would work. But in today's environment, this strategy of adding collateral security simply doesn't work. It's too messy. Lenders are getting awash with applications, and what they're doing is basically picking the eyes out of the developments that they want to lend to. They're just cherry picking.
The reasons why I said I'd be interested in the prior one is it was point Chev, wasn't it?
Yeah, exactly.
Yeah,
exactly.
So it's area, because you just know that's a bulletproof area.
Yeah, that's exactly right. Yeah. So just to wrap up, I just want to give you guys a back of the envelope calculation. When a client gives me a call and just talking really high level, I basically run this calculation, put the client on speakerphone and run this calculation on my calculator. So how many units do you think you can get on there? Take out the GST if they're selling it all, times it by 60%, gives me the total loan size, maximum loan size. Have you got an existing mortgage? Allow for consenting costs, civils. I ask them what they think their construction is going to be, and that's a real barometer about are they real or not real, or sophisticated or not, or how much homework have they done. Allow for some contingency, come up with the total cost. I can run this calculation very quickly now, but this calculator that I'm going to give to you guys, you can use. It's just a nice little simple Excel spreadsheet. Get the total development cost, take that away from the total loan size, and you can see if you've got space. I would call it a buffer. Now, so this site here, this development here, 6 units at 1.25. If that client got it wrong and they're only worth 900,000, all of a sudden, of course, it's not rocket science, it's non-fundable. They're going to have to put in that extra equity to get to that 60% LVR.
It's worth pointing out the obvious here to the listeners that you're talking about LVRs, not profit margins here. So this is all about what is your LVR on completion, and as opposed to the back of a paper bag calculator I sent you for looking at gross development margin. So actually quite a good thing to run in parallel. So this is a back of a paper bag funding calculator, isn't it?
Yeah, absolutely. Absolutely. Yeah, when I get a phone call, I'm a broker. I'm working out whether I can get them the money. I'm not telling them whether or not they should do it. Not like what the school is all about, whether or not they should do it. Yeah, exactly. Can I get?
So your buffer is what, 60% at 60% or 65%? Is it?
Well, that's right. That's what the lenders can do. So there's that safety margin in there. Yeah.
All right. Well, actually, I think we're getting towards the end. So if you want to rip through this, I've talked too much and ruined your presentation. So sorry.
No problem at all. Yeah. So clients will come to me and they'll say, so we want to purchase property. If they haven't already purchased the property, what are my options? Obviously, the cheapest option is first-year lender. And I heard you mention it earlier in the piece, Matthew. Buy it as a residential investment property. Don't collect GST on it. 60% LVR. That's the best. That's the cheapest option. The next option is going to a non-bank where you might get up to 80% LVR. The Select and the Resimax. The next option is going to an asset lender where they'll do little to no income assessment, and you might get up to 60-70% LVR. The other three options. But more often than not, I'm working with clients who already own the land, and so the next step for them is to get the consents: resource consent, building consent, engineering, planning approval. And it's going to cost them between sort of 300,000 to 400,000, well, 200,000 to 400,000. The cheapest option for them to do that is by getting a revolving credit, and they can use that money to get their consents. If they don't have the serviceability to do so, then we can refinance them off to an asset lender, and they might be paying between 6 to 8%, but it's only short-term money, short-term loan, between sort of 6 to 12 months, however long it takes to get those consents through, and then we're rolling into the development loan. And we've discussed all night about the development loans. So once you've got those consents, you've got the contract from the builder, QS involvement, insurance, valuations, pre-sales if required. That's when we package it up and we either go to a first-tier lender or we go off to the non-bank lender. And yeah, that's the end of my presentation. Thank you very much. Very good. Thank you.
If I could just summarise and say we've listened to two financiers, Chris Pearson from KPM Mortgages and Ammon. So which to choose? Well, you actually need both of them. So Chris does the non-bank lending with his non-bank contacts. He's really networked in that area. And he's also got the main bank lenders. And then when it comes time to do a development, it's a specialist area. Ammon is second to none, and he's got behind him a couple of very good senior bankers, which I've dealt with and do deal with clients. So I can really recommend his team on the development finance front. So a combination of KPM and Ammon is a very good team to have behind you. Thanks again, Ammon. We appreciate it and look forward to working with you in the years to come.
Thanks for having me.
Appreciate it. Thank you.